What's driving markets? Welcome to Market Take. Each week we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Devan Nathwani, portfolio strategist at the BlackRock Investment Institute. This week we unpack why strong earnings and higher bond yields are telling the same story. Rapidly rising earnings forecasts alongside higher long-term bond yields are not contradictory signals. We think they're telling the same story. Structural forces are reshaping markets, supporting earnings and keeping the cost of capital higher. Today's market isn't following the usual business cycle. 5 years after the last economic downturn, analysts are still raising earnings forecasts. In the past, earnings growth typically stalled and then contracted every 4 to 6 years. We see that as evidence that structural forces are reshaping markets. For example, the AI build-out is boosting productivity and profit margins, while supply scarcity is changing how capital is deployed across the economy. Those forces are changing how we think about long-term investing. But the same forces supporting earnings are also pushing bond yields higher. Governments, AI hyperscalers, and companies are all competing more intensely for capital. Combined with inflation uncertainty, we think investors will keep demanding more compensation for holding long-term government bonds or term premium. That's why we see a structurally higher cost of capital. We've argued that this environment calls for a different approach to portfolio construction. The industry's growing focus on the total portfolio approach reflects that shift. We prefer growth exposure through equities and private infrastructure equity over high-yield credit. Tighter spreads see us go underweight in high-yield credit strategically and reinforce our view that equities are better positioned if earnings strength persists. We favour durable income in select private credit over taking more duration risk in government bonds and global IG credit. Here's our market take. The same structural changes supporting stronger earnings are also pushing bond yields higher. We reflect that through our preference for equities, durable income, and limiting duration risk. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.